In this video, we're going to look at the very basics of the stock markets, how they are set up, and where the money goes when someone buys or sells a stock. So the term market is exactly what you may think of. It's a place where buyers and sellers meet to exchange goods. But instead of buying cereal or fruit like at your local market, in the financial markets, people and institutions buy stocks, bonds, funds, currencies, or derivatives like options. Broadly speaking, these types of products are called securities. Having this type of market structure is useful as it provides transparency, it allows for regulations on trading, and allows for the pricing of securities to be driven by supply and demand, ultimately leading to an improved efficiency of the markets. Now, the capital markets can be broadly defined as the stock and bond markets. In these markets, government agencies, public companies, and private companies can all sell securities to try to raise capital. Perhaps a municipality requires capital to finance a piece of infrastructure like a parking garage. Well, this municipality may elect to issue a municipal bond to raise the necessary capital. A similar scenario may be true for a public or private company that wants to raise capital by issuing a bond or perhaps ownership in their company, often called stock or equity. Now let's imagine that a private company is going to issue stock for the first time. Well, they do so on what is called the primary market. The primary market is where securities are sold directly from the issuer to investors. In this example, the company is the issuer. The primary market is where securities like stocks and bonds first become available. This initial sale is often called an initial public offering, or IPO for short. Now, generally, institutions like investment banks, endowments, mutual funds, hedge funds, pension funds, insurance companies, and so on are the only players in the primary markets. Usually, individual investors don't get to participate in the primary market. The secondary market, on the other hand, which you may often hear called the stock market, the New York Stock Exchange is a good example of a secondary market. While the secondary market has many individual investors participating in it. When stocks and bonds are sold, the issuer receives no additional capital like they do in the primary market. In fact, the key distinction between the two markets is that in the primary market, the issuer sells securities and they receive the capital. And in the secondary market, securities are bought and sold to and from other investors. So if an investor buys shares of a company through the secondary market, they are buying those shares from another investor. Therefore, it is ultimately supply and demand for individual shares that drive the price of any one security. Well, if there are more buyers relative to sellers, well, the price of the security will move higher. And the opposite is true if there are more sellers than buyers. The price would fall. That is the basics of how the stock market is set up and the key differences between the primary and the secondary markets. If you have any questions about the world of investing, any suggestions on videos, please post in the comments below, and please subscribe as we continue to update with new videos every week. Thank you.